All right, ready to really level up your trading? Forget all those complicated indicators for a second, and let's talk about the actual language of the market, supply and demand. We're going to learn how to spot the footprints left behind by the big institutional players, the smart money that really moves the market, and how you can trade right alongside them. But here's the thing, and it's a tough pill to swallow. A huge majority of retail traders, probably 90%, are getting this powerful concept completely wrong. They're drawing the wrong zones, they're falling into all the classic traps, and they're getting stopped out over and over again, all while the smart money is just raking it in. Today, we're going to fix that. Okay, here's our game plan. First, we'll talk about why trading with the institutions is pretty much the only way to go. Then we'll get super clear on what supply and demand zones actually are. After that, we'll get into the nitty-gritty of how to draw them, and then, and this is the most crucial part, how to filter for only the A+ setups. And finally, we'll put it all together with a professional entry strategy. Let's get into it. So let's just get one thing straight right off the bat. As retail traders, we're basically fish swimming in an ocean that's controlled by whales, the big banks and the giant funds. Their orders are so massive, they literally create waves in the market. And if you try to fight that current, you're going to sink your account, period. So the whole strategy here isn't about predicting the market. It's about learning to spot their massive order flow and just ride the wave with them. And this is exactly how we do it. These supply and demand zones are the evidence they can't hide. They're literally the footprints in the sand. These zones show us the precise spot where an institution pumped a massive amount of money into the market, creating this huge imbalance. Our job as smart retail traders is to become expert trackers, spotting these footprints and figuring out where that smart money is likely to step next. All right, so let's get down to brass tacks. What are we actually looking for on a chart when we talk about supply and demand? Let's define it nice and simple. In the simplest terms, these are just areas where the scales of buying and selling tipped dramatically. This isn't just random market noise. It's a clear, deliberate action. It's a huge neon sign telling you that a massive amount of money just entered the market at a very specific price level. And because of that, that level is now really, really important. And this breaks it down perfectly. On the left, you've got your demand zone. This is a spot where aggressive buying just exploded out of nowhere, sending the price absolutely rocketing up. So our plan is simple. We wait for the price to come back to this zone and we look for a chance to buy. Now, on the right, you've got the exact opposite, a supply zone. This is a peak where massive selling pressure came in and just crushed the price down. So what do? We wait for a pullback to that zone to look for a sell. Simple as that. So how can you actually see this institutional aggression on your chart? Well, you're looking for conviction. You want to see those big, fat, explosive momentum candles where the price is literally leaping away from a level. That is the visual proof of a major imbalance. What you have to avoid at all costs is that indecisive, choppy, baby candle price action. That slow, grinding movement. It tells you there's no institutional power behind it. It's just noise, and you want to stay away. Okay, theory's great, but let's get our hands dirty. How do you actually draw these zones on your chart? There are a few different ways to do it, and knowing all of them gives you a real edge. All right, so you've basically got three main methods. First up is the pivot zone. This is the classic one. For a demand zone, you mark the body of the last down candle right before that huge up move. It's great for precision, which means a tight stop and a great risk to reward. The downside, price may not pull back that deep and you could miss the trade. Next, you have the consolidation zone. Here, you draw your box around that whole sideways area, that little base right before the breakout. This is kind of like your safety net. You're much more likely to get your order filled. The trade-off though is a wider stop loss. And finally, for more advanced traders, there's the wick zone. You literally just use the wick of the candle. It offers almost surgical precision, but it is by far the easiest one to miss. And now we've arrived at what is without a doubt the most important part of this entire explainer. Look, anyone can splash a zone on a chart. The real skill, the thing that separates the pros from everyone else, is knowing which zones to trust and which ones to just completely ignore. This is your quality control. Let me be crystal clear about this. We do not trade every zone we see. In fact, most of them are probably going to fail. We need a strict, rules-based checklist to find the zones that have serious institutional weight behind them. The levels that smart money has a real reason to come back and defend. And here it is. This is the filter, you should probably burn this into your brain. Number one, and this is the absolute non-negotiable, the zone must cause a break of structure. We'll define that in a second. Number two, the move away from the zone has to show a strong imbalance. We're talking those big fat candles we talked about. Number three, and this is a huge one, the zone forms after a liquidity sweep. And finally, number four, the zone has to be fresh, meaning price hasn't come back to test it yet. That first touch is always the best. And A+ tops your setup. It checks every single one of these boxes. So let's quickly unpack that first point, the break of structure, or BOSS. This is your proof that the balance of power has actually shifted. So imagine a stock has been trying and failing to break above $50 for weeks. Then a demand zone forms down at $48 and just launches the price straight through 50, all the way to 53. That powerful move through the $50 ceiling is the break of structure. A zone that causes something like that is way, way more important than one that doesn't. It's a statement. Okay, so if the break of structure is the proof, this next idea, the liquidity sweep, is the motive. Understanding this is an absolute game changer. Think about it from a big bank's perspective. If they want to buy 1 million shares, they need someone on the other side selling them 1 million shares. So where do they find all those sellers? Well, they find them right above obvious highs and right below obvious lows, where all the retail traders put their stop loss orders. So they intentionally push the price just below a key low, triggering all those sell stops. And then they use that flood of selling to fill their own massive buy orders before launching the price in the other direction. A zone that forms right after one of these sweeps, that is a 5-star signal that smart money just showed its hand. So you've done the hard work. You found a fresh high probability zone. It caused a break of structure. It came after a liquidity sweep. You're ready. So let's move on to the final piece of the puzzle, how to actually get into the trade like a pro. You know, the single biggest mistake traders make is getting FOMO, that fear of missing out, and chasing that first explosive move. Please don't do it. That's what amateurs do. The professional approach is all about patience. You've identified your zone. Now you just sit back and calmly wait for the market to come to you. You get in at the source of the move, not halfway up the flagpole. And even when the price finally comes back to your zone, you don't just blindly click the buy or sell button. You wait for one last piece of evidence, confirmation. You let the market prove to you that the zone is holding. So picture this, price enters your demand zone, you're just watching. Then suddenly you see a long wick stab down and get violently rejected. And it's followed by a huge green candle that completely swallows the previous red one. That bullish engulfing candle, that's your confirmation. That's the market giving you the final green light to pull the trigger. And that really brings us to the one fundamental question that should guide every single decision you make in the